Have you ever heard of stablecoins? These are digital currencies designed to maintain a stable value. But what exactly makes them different from the regular cryptocurrencies like Bitcoin? In this video, we're exploring the IMF's latest research on stablecoins, digital currencies designed to stay stable. We'll cover their growth, uses, and the risks ahead as mentioned in this report. So, let's dive in. Unlike volatile cryptocurrencies, stablecoins aim to keep a fixed value against a currency like the US dollar. The biggest players? USDT and USDC with 90% of the market share, mostly backed by US government bonds, cash, and even some gold. Stablecoins are booming. From 2022 to 2023, their issuance has skyrocketed, hitting $300 billion in 2025. But even with all that growth, they still make up just about 7% of the total crypto market. In our previous videos, we've discussed in detail the 2025 boom of stablecoins. Be sure to check out. I'll share the link in the description for you. Currently, most stablecoins are used for crypto trading and as a bridge between cryptocurrencies and traditional money. But that's changing. Stablecoins are now being used for cross-border payments too, offering faster and cheaper alternatives to regular bank transfers. Though stablecoins are meant to be stable, there's always risk. In 2023, USDC dropped by 12% due to the Silicon Valley Bank collapse, and USDT also faced dips after the Terra USD crash. These events show how the system can wobble if trust falters. So, what's the future? Stablecoins could become a go-to for cross-border payments and even retail transactions, especially in countries with unstable currencies or weak economies. But their growth depends on strong legal frameworks and clearer regulations. This is a stark contrast to traditional cross-border payments, which are largely dominated by systems like SWIFT. The demand for stablecoins could also be significantly driven by macroeconomic factors such as high inflation and unstable local currencies in certain regions, where stablecoins could act as a hedge. As the majority of stablecoins are pegged to the US dollar, their future growth will likely hinge on the continued dominance of the dollar in global finance, trade, and reserves. In fact, the share of the dollar in global transactions considerably exceeds the US's share of global GDP, which further strengthens the case for stablecoins pegged to the dollar. But it's not all smooth sailing. Stablecoins can pose risks, like currency substitution in economies with high inflation, or even financial instability if large-scale adoption happens too quickly without proper regulation. Countries are still figuring out how to regulate them effectively. Governments around the world are catching up with regulation. In the US, Europe, and Japan, regulatory frameworks for stablecoins and other crypto assets are starting to take shape, but they're still in the early stages. In the United States, regulators have been working to define the role of stablecoins within the existing financial system. The Biden administration's executive order on digital assets and the US Treasury's focus on stablecoin regulation are indicative of a shift towards a more defined legal landscape. However, challenges remain, particularly in addressing the risks of market volatility and consumer protection. In Europe, the Markets in Crypto Assets (MiCA) regulation is one of the most comprehensive frameworks being developed, with a focus on providing legal certainty for stablecoins and ensuring that issuers meet minimum reserve requirements. While MiCA aims to harmonize regulations across EU member states, its implementation will take time, and questions remain about how to manage cross-border flows effectively and mitigate systemic risks. Japan has been a pioneer in crypto regulation, and its legal framework for stablecoins aims to prevent illegal activities while fostering innovation. Japan's approach focuses on consumer protection, anti-money laundering (AML) standards, and ensuring that stablecoin issuers are properly licensed and have sufficient reserves to back their coins. Despite these efforts, much work remains in bridging the gaps between current laws and the needs of an evolving digital asset market. Effective regulation will be critical to ensuring that stablecoins and other digital currencies don't disrupt financial systems. Regulatory clarity will help safeguard financial stability, protect consumers, and mitigate the risks posed by the volatility of underlying assets. Properly regulated stablecoins could integrate seamlessly into the global economy, providing an efficient means for cross-border payments and reducing reliance on traditional banking infrastructure. However, the regulatory frameworks must be agile enough to adapt to technological advancements and evolving market dynamics to prevent new risks from emerging. Therefore, international cooperation among regulators will be essential to create consistent and effective regulations across jurisdictions. In conclusion, stablecoins are growing fast, but with that growth comes responsibility. Proper regulation and strong market confidence are key to their future success. As we move forward, we lead a balance of innovation and caution to ensure they benefit both users and the financial system. Stablecoins hold great potential for transforming the financial landscape, but only with the right regulation and trust. The future looks bright, but it's up to us to ensure its success. If you found this video insightful, don't forget to like, subscribe, and hit the notification bell for more updates on the world of digital currencies. I'll see you in the next video. Until take care and bye-bye.